You want to find some assets to buy and sell? Yeah, me too. All right, let's get on with it. Guten Morgen. Comment allez-vous? How are you? Welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with an overriding goal of trade planning. Let me remind you that trading, even with a plan, is risky and not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hey, my name is Wayne. How are you? Comment allez-vous? Hey, the secret here, the way that the sausage is made is that you ask questions, and I will share from my almost 20 years of experience trading Forex. I am a macroeconomic trend trader. I have a degree in macroeconomics, so feel free to do a deep dive in those questions. Once I've made a decision on my macroeconomic fundamental bias, then I use technical analysis to confirm the price and time. So if I want to buy crude oil, I say, is this the right price and is this the right time? So, hey, that's a little complicated. Well, then ask questions. I will do my best to answer and address your concerns and needs. Also, I would guess at least 50% of the people in this chat that will attend every day and also are members of FX Bootcamp, which means they've gone through the 65 hours of training probably 2 or 3 times. Some people here have known and traded with me for almost 18 years. Think of that. They could have kids when we started trading together, and now those kids are in college. Interesting perspective, huh? So anyways, this is complicated. If I can't address your question, there's many people here that might be able to help. Or maybe you just join fxbootcamp.com and get on the clue train. Oh my God, it's $88 a year. So if that deters you, there's nothing I can do on the short run that's going to help you get out of your plight. Okay? So anyways, ask questions, get involved, and there's a whole community here that can help. There are other resources besides these 5,000 to 6,000 videos I've done on YouTube. And of course, 10 years before YouTube, 5 years before YouTube, I was doing daily live streams just on different technologies. So anyways, if those 6,000 free resources don't help, if you look in the description below, there's a link to a free training course, youtube.com/fxbootcamp. If that's still not enough, there's a book you can buy on amazon.com. 3 weeks before before Amazon was actually shipping the book, it was the #1 bestseller for the foreign exchange category on Amazon. Cool. Some people say it's pretty good. There's a few reviews that say it's the worst book ever written. Okay, well, I'm not a professional writer. That was the first book I ever wrote. So anyways, I don't think it sucks that bad, but it might be okay. What other resources? In the description below, again, to FX Bootcamp, you can get the premium training and access to a community of foreign exchange traders going through the same process that you are. Some are just learning technical analysis. Some are actually practicing and learning how to be a professional portfolio manager on a trading desk, on a foreign exchange hedge fund trading desk. So the spectrum of education is quite high. There's also links to, like, for example, tradersway.com. You need an ethical, trustworthy, professional organization to execute your trades. They manage the servers. They manage the compliance. They manage the liquidity providers. They manage the risk. There's a lot that they do. But as from a trader point of view, you can see that they execute your trades quickly. The spreads are narrow. Okay, the swaps are big. And these are all awesome things. So if you don't know, now you know. You know? Huh? Now you drink champagne when you're thirsty. So tradersway.com, that link is in the description below. If you're worried that if you click the link, I'm just promoting this so that I earn some sort of commission on your trading, then don't click the link. Don't click the link. Don't do it. Just go type it in, tradersway.com, and open up a demo account and see for yourself. See if they can earn your loyalty and respect. Do your own due diligence, son. Okay. By the way, I guess I should plug it. I just happen to have WTI on. I've been watching it all morning. Hey, I'm doing a training course, a very, very, very deep dive, nuts and bolts. For example, this is the machine that does this thing. Here's the thing that sucks the oil out of the ground, and then it goes into a little pipe, and it goes to this machine, and it goes up to here, and it changes heat and pressure, and it separates here, and this thing goes to this pipe, and this other thing goes to this other pipe, and then it goes to this other machine, and this other thing happens. Real deep dive, as well as here's the geology. This is the ground. This is the rock. This is the sand. Here's the flavor of oil and its viscosity. And if it's too light, what do you do with it? If it's too heavy, what do you do with it? And then who buys this stuff? And what happens there? And how do they turn this stuff that comes out of the ground, how do they turn that into jet fuel or lipstick or plastic or tar or gasoline? How does that happen? And how does it get sold? What's the positive and negative impacts of all of this? If you happen to have oil on your land, what kind of contracts do you negotiate? Yeah, actually going through the legal contracts. I've decided to charge $500, $499. I have a PhD on staff helping me do the research and do the slides. It's going to probably be about 16 hours long. It's going to take us probably 16 weeks to get through it. I'm going to call it summer school, and it'll be an awesome experience, I think. And of course, when we get down to it, we'll cover things like, well, how do you buy and sell? And most importantly, you will absolutely know through empirical research whether you should be a buyer or seller or neutral. Okay? And then you'll say, you know what? When President Biden comes out and says Exxon makes more money than God, and that is putting together a task force to prevent gas stations from gouging consumers, you sit back and go, what the hell is he talking about? He would rather fly to Saudi Arabia next week and talk to them than talk to his own oil industry? What the hell is that? Or at least that's my opinion on how I interpret the facts. But then that gives me an outlook. Are oil prices going down anytime soon? And is it really the war in the Ukraine? Really? This is Putin's tax? Okay. So anyways, I want you to be informed so you can make your own decision. After this course, you might look at all the same facts and say, Wayne, I disagree with you. Look at this, 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 and this. And we can have an intelligent discourse. Versus like, I don't know, the MACD said to buy it. Okay? So that's what we're going to do this summer. I hope you're into it. Okay? Gregor said, hey, I'm glad I'm a Forex trader, not a crypto or stock trader. Well, yeah, I guess so. Okay, I guess so. There's different ways of looking at it. I think being a day trader in some of those things could be good or bad. Really also depends if you're an investor or a trader. Also depends on how much leverage you have. Also depends on your outlook. So buying like Bitcoin around 10 or 20 might be awesome in 15 years. I remember I didn't buy Bitcoin at 1,000 because it was ridiculous. Now 20,000 looks ridiculous. So anyways, so let me ask you again, because I asked you guys, I don't know, about a month ago, if I should do a crypto course or an oil course. And the vast majority of people said oil and said they would do it. How many people, now that I'm putting together, we're probably halfway through the second lecture already. The first one's going to be a general overview of the entire energy complex, just a quick burn through the whole thing to set the stage. And then the second one, again, to set the stage, is the entire history of the oil complex. Not just what it is, but where did it come from? So let me be bold and ask you, how many people are going to sign up and do summer school with me? We'll probably, I'm guessing we'll start in the middle of July. Maybe I'll do one a week. Maybe I'll do 2 a week. I haven't decided. But how many people are in? JP's in. Anurag's in. Yep. She's right on. Good, good, good. Okay, we haven't covered we haven't even covered the cost of my PhD. Yeah, Daniel's in, Gary's in, Denise is in, right on. Inflatable boats, IBS, irritable bowel syndrome. IBS is in, right? Pete's in. Peter, P-Dub. Come on now. You know, one mini lot today would have paid probably 2/3 of the course. Okay, here to here is probably 2/3 of the course right there in the last hour and a half. Okay, Zach's going to be there. Cool. And that's a mini lot, guys, and that's not a full lot. So if you're trading minis, it could be interesting because, for example, in the last hour and a half to 2 hours, oil moved more than, let's say, pound dollar will move all day. And if you did any of my sort of quick trading on oil in years past, you'll know that I've already talked about this. I've been doing this for a while, where from here to here is predictable, not just direction, but time. And that exiting is also predictable. Okay? Greg says socialism. I'm not sure what you're referring to, Greg, but that's pretty funny. That's my answer to half of everything, Greg. Right? Why is the stock market going down? Socialism. Anyways. All right, cool. So there's the big plug of the day. Just trying to see if I can get my my investment back. That's cool. All right. Let's start with the indices. Dollar's still reasonably strong. That's right, Steve. All the live streams are already scheduled and on the YouTube channel homepage, youtube.com/Forex.Today, and they're all scheduled for 9. Yes, I'm on summer hours, which is great because you think, oh, that means I sleep in. I actually get up an hour earlier. I'm trying a new, now that I'm studying Stoicism, I'm trying to make various changes in my life, and I'm doing a mediocre job of it, but I'm trying, and I guess that's the beginning. And the interesting thing is I'm trying to go to bed by 11:11 at the latest. Oh, is that what it is, Jim? All right, well, maybe I will. All right, so I try to go to bed by 11:11, and I try to wake up at 4:44. And it's an interesting new balance. I'm like, oh my God. A new balance. Anyway, so I'm trying to, live a more balanced life, which is funny. Everyone around me would laugh hearing it, but again, I'm trying. All right. So dollar's still strong. Look at this, okay? Yen all over the place. Let me show you something interesting. Let me show you something interesting that happened yesterday. Oops, wrong link. Hang on. Un momento, por favor. Here we go. The yield on the 10-year JGB. By the way, we did talk about this last night. And what? Holy schnicker-schnocker. Something happened here, huh? Holy smokes. The Bank of Japan stepped aside and said, hey, I wonder what would happen if we just step aside for a second. Oh my God! And the cool thing is, last night in the day trading group, we talked about it. Yield curve control is going to happen tonight. Boom, boom. Interesting. So anyways, now we're right back to where we should be. But if you weren't sure if the Bank of Japan was intervening in their bond market or not, now you know. Okay. Cool. So that's interesting. Anyway, so you're like, interesting. All right. So Euro's recovering quite strong. It's been strong all day, all night, whatever your point of view is. And like I said, and I've been saying this a couple of days now, I guess since last week. Yes, we are disappointed that the ECB is going slowly. But I even prepared you before the rate hike that was pretty reasonably likely. Okay? Pretty reasonably likely. Now that I shorted it and I made some money. Great. Now what? Well, then people are like, they sit back and say, hey, wait, okay, yeah. They didn't raise by 50 bips, but they did raise, or they did say they were going to raise. And that is a change. And that they'll probably raise a few more times, maybe. Okay? So last night's discussion in the day trading group, and yes, that's a plug, I think you should join. One of the things we talked about, besides Japanese 10-year JGB yield curve control, otherwise known as qualitative and quantitative easing, one of the other things we talked about is the mandate at the ECB, so that we could maybe understand this. And now we have, well, besides the dollar, it's the only thing strong. Which means if you got all this weakness and a couple of things strong and you're trading euro dollar, you don't get it. Like, oh my God, you should fall out of your chair. In fact, you should throw your chair. Wait, don't throw your chair. If you're trading euro dollar today, you don't get it. You don't understand the basic fundamentals of foreign exchange trading. This is not to publicly shame you, because you're the only one that can see this. You're the only one that can see your trading. But if that's what you've been doing, you really need to up your game, and that is through education. Okay? I'm telling you, just don't fight me on this. Don't say, Wayne, you're insulting me. I'm not insulting you. I'm waking you up. So, right, you have capital and labor. These are the two factors of production. Okay? You are the labor, and you need to increase your alpha. Okay? And that happens through training and education. Again, you think I'm pitching you and selling you. Dude, I'm bringing the facts. Okay, I'm telling you like it is. If you're trading these two things, I don't even care what direction you're going. You just miss the whole concept of foreign exchange trading. And if your guru told you to trade euro dollar today, you need to switch teams. All right. Okay. Coolio. So let's start with the buck. Okay. And there's your euro dollar. Up. Kinda. And now farting around sideways. So one of the things I could do here is I can move my stop just above here and lock in. That's 167 pips. I'll just lock in 150 just to be, there we go. I just locked in 150 pips profit. Okay. The thing is, if you have traded in here in the smaller time frame, in the smaller space, and I don't care if you're making pips. I don't care if you're counter trading and all that kind of stuff. Even if you're making pips right now, you missed probably 5 to 10 different trades that would have made you more pips. What you're doing doesn't make sense. Even if it's going up or down, whatever time frame you trade, whatever technique you use, you're like, but Wayne, I'm just buying, I bought the dip or I sold the rally or blah, 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 blah. Okay, great. And you're up 50 pips for the day. Great. You gave up 3, 4, 5, 6 other similar trades that would have made you 100 pips or more. So even if you made money here, relatively, you made a silly decision. Okay? So you made 50 pips there, and this one made more than that. Okay? So now, if this is a short-term top, what I could do, again, this isn't necessarily the right thing, but I can move that and lock in pips and let it run. Okay? Am I concerned about the bottom? Yeah, sure. Okay? So what euro dollar did was it pulled back and then is farting around like this. Meanwhile, this just dropped. Why did euro go up and move sideways? Because both euro and dollar are strong. Denise says, makes sense, right? Well, it really depends when you made those decisions. Knowing to just never buy that or whatever and move on to something else is super important. Whether you do it on a spreadsheet, and again, I'm teaching the day trading group on how to do this. Or is it the swing trading group? I guess it's the swing trading group. We've made a whole spreadsheet and quantifying values, assumed values, qualitative. Now it's we start with quantitative analysis and then we move over to qualitative. Does that mean we want to buy euro? Does that mean we want to sell pound? And we've organized all these things. Okay. And then you maybe open your indices and then look at, well, what's happening today relative to the model. And you're like, yeah, euro is going up and that kind of makes sense. And dollar's going up. Yeah, and that makes sense. So you just wouldn't even trade euro dollar. Now, I sold off euro because of the disappointment. And now I've locked in 150 pips profit, worst case scenario. I think that's a trade inside of the model. But to have traded it today was kind of silly because I traded the news, so to speak, relative to now. Maybe you're just trading it because it's habitual. Okay. Is that right, Gregors? Cool. Turns out Greg Anderson is Pamela Anderson. Awesome. Mystery man. Mystery man, right? Cool. I don't think I have it. I just pulled it up. I don't know if you just sent it. I don't think I have it yet. But some guy did send me an email and he said, hey, I'm a member of FX Bootcamp, but I don't know how to join the day trading group. Log in to fxbootcamp.com, and at the bottom of your dashboard, it says upgrade your account, and it offers a swing trading group or the day trading and swing trading group. And you just click on that, upgrade your account, and it unlocks those different parts of the site. Okay? All right. Cool, Gregers. Greg. I have my guesses. Okay. But if you are Pamela Anderson, I want to congratulate you on the relationship you're maintaining with Tommy Lee as parents. I think you've come together. You've handled your personal issues and your drug issues and got past all that and are trying to do your best to raise your children. And I applaud you for that. Very stoic. Did I ever S&P? Well, what I said not long ago is, 3,000 is not unreasonable. Now, I don't know if it'll be now, but it could be next year. Could be. So I'm thinking like the S&P 500 has a rally, but I think it's going to be a false rally again, maybe soon, like literally in the next week or two, maybe tomorrow after the FOMC decision or something. I don't know. People say the worst is over. Okay. And then we get some false rally. I won't believe it. I think there's a lot of professional traders that will short the rally. I think there's a lot of professional traders that will say, hey, man, a 15% rally or a 10% rally in the S&P will give them an opportunity to get out of some dead horses that they're stuck in, and they're sweating bullets, and they're way down, and that rally will give them an opportunity to get out of stocks that are punishing them. Just because you're a professional trader doesn't mean you're any different than you or I. And so you've probably been in a trade where you're losing big and you're sweating bullets and you're praying to God, please go back to break even. And then you gain back about half of your losses, and then you can see the weakness again, and it's going to roll over. And if you make the right decision, you might say, you know what, boom, I'll take half the loss. I'm so lucky to just have half the loss. I think there's a lot of professional traders that have dogs with fleas in their portfolio, and a 10% rally, and maybe in those individual stocks, those end up being 20% rally, they'll happily get out. I think a lot of what's going on with crypto has to do with people being over leveraged, and they're getting called and they're dumping. And like I said, after the problem with Binance yesterday, I said there might be a lot of people that have been trying to sell and get out of their positions and go back to US dollar, but they haven't been able to do it, and that there might be another leg down, and there was another leg down. See? Okay, so I think we need to go through this. It might be a year or more. It might be 2 years. It might be a year and a half before we get any reasonable recovery. And the logic I've been plotting out is that what's happening now is inflation or interest rate related. And I've done this so many times, but that's maybe good education, right? The present value of a stock or the S&P 500 or an apartment building for that matter, okay? As a model, you could say is the future value, the future cash flows, okay, over 1 plus I to the n. I could equal inflation. I could equal interest rates, depending on your point of view and your asset class and all that. N is how many years out that you're looking. So if you're saying, what's the present value of Google? Okay. Well, how much is Google going to make this year? How much money is Google going to make next year? How much is Google going to make 3, 4, 5, 6, 7 years from now? You might say your model is based on your guesstimate, of Google's revenue stream every year for 7 years. So you could do this, but the problem is if you do it that way, all you're calculating is the value now of Google's revenue stream or profit stream. Again, you can, whatever you want to put in here, on the 7th year from now. So you have to go, let's say 1 billion this year. Okay. Plus 1 billion next year. Plus 1 billion 3 years from now. Okay, so on and so forth all the way to the 7th year. Do the math and you bust it out. So right now what we're saying is, well, interest rates are going to go to 3%. No, they're going to go to 4%. No, they're going to go to 5%. Or they're going to go to 3%, then 4%, and then back down to 2%. And you insert those variables into your model and you do the math, boom. It knocks out the exact value to the penny. Okay? Is there an aim to this channel? Yes, I'm trying to bore you. But if you can't handle the truth, okay? Anyways, so that's what's going on now. We're changing the I variable. Now the next wave, and we might be getting this now, we might do this next year. I don't really know how people are modeling, but what if you thought we were going to go in a recession next year and Google instead doesn't make 1 billion, it makes 900 million. And 5 years from now, it makes 1.1 billion. But that's 4 years from now. And that 1.1 billion, well, depending on inflation, in real terms or not, also money 4 years from now isn't necessarily worth that much today. Again, you could say, well, because that's a guess. So if someone said, well, I'll pay you 1.1 billion in 4 years or 1 billion this year, you're like, F you, give me my billion. I don't care about the 100 million. Just give it to me now. But there's actually math to figure that out. And you might actually do the math and find out that's not a good deal. Or maybe it's a fantastic deal. So step one decline in the stock market has to do with your calculation of I in your valuation model. Step 2 is the FV, the future value of cash flows. Now, by the way, you can do this with an apartment building and come out with the exact number of the value of the apartment building. And you might find that someone's asking for 25 million for the apartment building, and then you say, okay, well, give me your financials. How much has your rent been? How much have your expenses been? And now you might tweak your beliefs and your bias based on your expectation for the neighborhood, your expectation for the city. So you might say, well, this is Austin, Texas, and everyone from California is moving to Austin, Texas. So, right? So you're like, okay, so over the next 10 years, there's going to be a good trend. So you might even pay up a little bit more. But nonetheless, you add up all the revenues, you add up all the expenses, you project that out, let's say 5 years, because if you get a mortgage this year, 5 years from now, you're going to have to refi. And if that asset has gone down in value, you'll never refi and you'll get screwed. You'll lose money. So you're like, okay. So you take all of this, you do the math, and the apartment building is worth 24,372,641. And they're asking for 25M. At face value, you can say, well, you're almost $1 million too high. So you can try to negotiate down. Okay? But then you can say, well, but the neighborhood's going to grow. The city's going to grow. This is a good neighborhood. There's a Starbucks. There's good restaurants. There's a nightlife. There's good schools. People are going to want to move to this neighborhood relative to other ones. You might have some cash left over to renovate and push rents up. So you're like, okay, because it's a desirable neighborhood in a desirable city, you think in year 4, before the 5th year of refi, you'll be able to raise rents by 10%, increasing your net operating income, but also you're showing the bank the asset has appreciated because you've increased your future cash flow, or in that case, the cash flow of that year, up. And therefore, you're increasing the present value of that asset. And now you refi and you can put $300,000 in your pocket or $3 million into your pocket and continue to have the renters pay the mortgage. So the second wave of down might be next year, where we're like, oh my God, the US is going into recession. Interest rates might be falling at that point, or soon will fall, but cash flows are falling, and then you might have another leg down. So again, how do we put this into perspective? Stock market's way down, but it should be. You thought Peloton was worth $2,000 a share? You thought Robinhood was worth $1,000 a share? Right? You're like, are you nuts? Right? So you start with that, and then next year we have another recession. So we hit a bottom, there's a pretty decent recovery, and then it just farts around. There's going to be a big rally at the end of the year, and then next year could be the next leg down, not because of inflation. And like I said, if there's a recession, the Fed will have to normalize, lower rates from 3.5 down to 2.5. So interest rates might be falling, but also the stock market could go all the way back down. So again, let's say we're at S&P's at 3,500, it goes back to 4,500, and then it goes all the way down to 3,000 next year. Okay? Now, you can do other things, right? Like the expected return of a stock is equal to the risk-free rate of return, right? The 10-year T-note, for example, the beta of the S&P 500, right? The expected return for the S&P 500, okay, minus the risk-free rate of return. Okay, so the expected return for Google, how much is Google worth is what we're trying to say. Well, what's the yield on the 10-year T-note? Is it 3, 3.5, 5.5? Matters. What's the beta of the market? Okay, what's the expected return for the S&P 500? Minus 10 or plus 10? Minus that 10-year T-note again. Is it 5.5 or is it 4.5? Is it 3.5? And so you throw in these numbers and you go, but, and by the way, it's not the beta of the market. I think I misquoted that. It's Google's beta relative to the market. So this is opportunity cost. This is the market. This is the volatility relative to Google and the S&P 500 and the yield on the 10-year T-note. So you have to do the opportunity cost. Because if you did a risk-free trade, like bought a 10-year T-note and paid you 3.5%, then you could have just had that for free. Not free, but much lower risk. Your risk really is inflation. But Google could go up 10%, down 10%, right? It could go down 20%, up 100%. So you're like, well, what do you think the S&P 500 is going to do? So you're going to model that out. And you're like, I don't know what the S&P 500 is going to do over the next 18 months. Then you're not a professional investor. You don't know. You can't even think about it. Well, how would I know the future? Well, you have to do some fundamental analysis of the market, of Google, of monetary policy. Even global macroeconomics would help. Is the supply chain issue going to be resolved? Are oil prices going to come back down to 85? And if your answer to any of that is, well, I have no idea, then you're not going to be able to do this, and you're not going to be able to intelligently make a decision on Google. But this is what a professional investor would go about thinking about it. It's not the formula, because I think the formula is stupid. Let's just be clear about that. My Harvard professors didn't like my argument. They're like, cap in, we've been doing it for 75 years. I'm like, yeah, well, people don't invest into the stock market like they did 75 years ago when there was like 9 stocks, okay? But nonetheless, what do you think the risk-free rate of return is going to be? Are you looking at the beta of Google? And what do you think the S&P 500 is going to do? Okay? By the way, these would match, right? So if this is 5.5, this is 5.5 because it's the same variable. So these are things that are happening. People made wrong assumptions. For example, the risk-free rate of return is going to equal 0 forever. That's what happened, let's say, with quantitative easing. And it was near 0 for a decade. Now the risk-free rate of return is being argued is probably closer to 4, not this year, or 3.5 is probably more likely in my opinion, next year. So if it was 0 last year, 1 this year, and next year's 3.5, then all the models based on the capital asset pricing model or the present value of future cash flows model, all the models say down. That's all. Okay? But there's a lot of people that made wrong assumptions and they said 0 and then 0, and they're wrong and their portfolio has dropped. Okay, which means maybe if you do month to month or something like that, maybe they had when money was free, they had a good month, 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 less good, and all of a sudden it was clear the Fed was going to raise interest rates, and now they're having these bad days, and you organize them into a normal distribution, and you look at their tails. And you're like, now that this is happening, how many of their trading months are on this side? And if this continues, how much risk are they taking? And we call this value at risk. So you gotta organize them and then normalize them and look at, you're kind of organize them by variance. And then say how much risk do they have in their portfolio now, and it's increased exponentially, not because of their trading, but they made bad decisions, and now they've had good days, good days, good days. So like a couple of years ago, Cathie Wood had all her money, billions of dollars, into growth stock, and growth performed. So she had all these fat tails on this side and very few losing days because free money pushed up growth, because companies that really, some of them don't even have profits, could just keep borrowing free money and can put it all into marketing, put it all into advertising, get new customers, and then the stock goes from $100 a share to $1,000 a share, and everyone's like, see, it's a good company. No, they don't have any profits, and they're borrowing money for free. But as soon as that free money went away, they went from fat right tails to fat left tails, and their risk is increased because of their poor performance. Really what happened is, I think it's kind of foolish to open up a fund that says we're going to put all our eggs into one basket. And you're like, what do you mean all your eggs? One of them is an exercise equipment. right? So they bought Peloton, maybe they bought Netflix, they bought Zoom, they bought Robinhood, and that all worked, but it was the same bet. And then as soon as the market changed from free money to much more expensive money and maybe a potential slowdown, okay, their value at risk went up because their portfolio is misaligned. And that's why you want to have some sort of diversification. And that's the dangerous thing with hedge funds, because they come up with a product. They're like, what do people want to buy? They want to buy growth. Boom. So they go out, we have a growth fund and we're going to put all the money into growth stocks. And it'll do really well until it won't. Okay. So anyways, all of this stuff is going to have, or is related to I right now. The next one will be future value of cash flows. And that would be the next dip, probably. Or it's already begun. And we go all the way down to 3,000 now on the S&P 500. Okay. Remember Robinhood? You can buy it for an 86% discount from the high. And so now some people are in positions where they're forced out, like margin calls. And I think that's kind of what's happening with crypto right now. Let's take a look at US, what do we call this? Kiwi dollar. Okay, I can again move this one. This one is 100 pips profit. This one is, I'll just move, well, 115. Do I care about that? Maybe I'll just move this to 100. All right, cool. So 100 pips profit, 100 pips profit. Let your winners run. Cool. So that's good. So what? 150 and 150 and 100 and 100. Starting to add up. Where are we here? New lower low. The stop is above the sell zone. This is a, I will lock in. I will lock in. That's 400 pips. I think that's a little too far. Yeah, screw it. All right, I'm going to lock in 400 pips profit on that one. Birthdays is the worst days. Now I drink champagne when I'm thirsty. Yeah. Cool. And then lastly, one more dollar trade. Let's move this one. Not as good. Look at this. Feels pathetic, right? Oh my God. Only 100 pips. It's only 75 pips. This is 100 here. I'll live with that. Okay. Thomas logged in late. Come on, Tommy. And what do you think about euro dollar? I spent 5 minutes talking about euro dollar. Okay. Anurag says, hey, can you talk about pound? I've made my bearish outlook on pound incredibly clear. Now, you're asking me other things like when to get out. I'm not your financial advisor. Okay. I don't know the future. But I'll teach you technical analysis so you can make your own decision. Okay. Louise said, hey, the same thing happened back in the 1970s with the stock market and stuff. Yeah, but like, again, I think most retail traders look at stocks and the stock market as an abstract. It's good, it's bad. It's going up, it's going down. but they're not creating valuation models. Like I'll make up a number here. I don't know the value of Google, but let's say it's $1,000 a share, and you're like, that's too expensive. But then you find out it's trading at 6.5 times next year's earnings. Well, then it's cheap. Relative to what? Well, what about, let's say, I'll pick a Netflix. Netflix is trading, I'll make up a number, $175. Okay, dollars. Keep your units, right? And it's trading at 13 times next year's earnings. Which one's cheaper? You might say, oh, this one. No, it's not. This one's cheaper. And then, of course, will either of these businesses go out of business next year? Well, I think there's 200 million customers, and that'll probably go up or down or sideways. And then, so will people stop watching Netflix? Probably not. Will people stop using Google to search? More importantly, will companies looking for customers stop investing into advertising on Google? Maybe, if there's a recession. But maybe it makes the other ones advertise even more. So I don't know. Now you got to break this down. Okay? But of course, you can do all that stuff and still lose money. Let me show you a video. You can do all that and still lose money. Let me try to find a video. Where do I keep these things? Or do I keep these things? Or can I keep these things? Where's the Fox business? How do I search on here? Maybe I can search my own channel. Hang on, it's kind of interesting. How do I search my own channel? It's so funny. I don't know how to use YouTube. All right, let's do this one.
U.S. markets is driving some investors to foreign currency. Joining us again from Atlanta with some tips on trading and foreign money is Wayne McDonald. He's Chief Currency Coach at Forex's FX Bootcamp. Wayne, good to see you. Thanks for coming back. Last time we kind of shortchanged you, so we're glad you could make it back. Basically, details of what the bootcamp is all about first.
Well, first of all, FX Bootcamp is an organization that teaches people how to trade currencies. But what makes FX Bootcamp unique is that we teach people live while the market is moving. So sure, we teach you technical and fundamental analysis, but most importantly, we teach you how to be a trader by
see, you used to be a supermodel.
As much as 12 hours a day, and explaining what's happening in real time, helping you set up your trades pip by pip, candle by candle.
You know, I was a little bit skeptical at first, but the more I looked into it, because it's such a volatile market, there's nothing more volatile than currency. It's where a lot of the real high rollers are. But you are very conservative in currency trading, putting in stop loss orders every chance you get, right?
That is absolutely correct. You know, Forex is very, very risky, but, you know, honestly, whether you're trading in commodities or equities or in currencies, risk is always going to be inherent. And what you do to manage that risk is roll up your sleeves and do the hard work. So, for example, let's say someone wanted to pick a stock. Well, it's well known that you need to research the company's product and service. You need to get to know the management team, and you have to have a reasonable comfort that the company is going to produce profits in the near future. And if you're right, hopefully you make money. But sometimes, even when your analysis is right, you still lose. But you know, Forex is not that different. Right. You still need to gather your intelligence, and you need to formulate a strategy. Okay. Most importantly, importantly, you need to have the discipline to carry out that
Wayne,
plan.
one thing, less people think that it's unexciting. You do rolling stops, right? You train people in how to do rolling stops. Explain what that is, because this is where some real fast action happens.
You're right. Currencies can move up and down minute by minute, especially with news. You know, ISM really moved the market, and non-farm payrolls coming up will move the market. When you place a trade, what you do is you put a stop loss that's not that far away, so you know that if you are wrong, and any variable around the world can make you wrong, that your potential loss really shouldn't be that big of a deal.
But we're talking, in terms of trades and time, we're talking about a 5-minute turnaround here. If you put it down with a stop loss on it, 5 minutes later, you've made 10 basis points, whatever it is, and immediately you turned it around because of that stop loss. So these are quick trades.
Sometimes that's true, and when news comes out like ISM today, I held a trade for about 17 minutes, so that's not that big of a deal. But the beauty about Forex is that it trends so well. So for example, the best place to put your money right now anywhere in the world is in the US dollar, and that US dollar has been strong for 8 or 9 months. So you don't have to trade every single minute or every single hour.
Wayne McDonald.
Go with the long-term trend.
It's very exciting, but there are ways to play it safe as well. It's great stuff. Thank you, Wayne. Good to have you back. Appreciate it. Well, searching for the answer to business success.
So anyways, that was a weird experience being in the studio, because they're not in Atlanta, right? So anyways, that was a really strange experience I'll never forget. That was, I think, the second time I was in at Fox Business. What year? I don't know. You'll have to Google it. But so what I said is you can do all the good, analysis and still be wrong. So for example, the entire stock market is coming down. A high beta stock is going to come down more than the S&P 500. A low beta stock is going to come down less than the S&P 500, but it's still going to come down nonetheless. So Google might have a great management team. It might have great cash flows. It might have all these good things that make you want to buy a stock, but the stock price is falling. That's how I kind of look at trading, where I start the fundamentals first, make decisions. So a fundamental analysis of a stock, for example, you do your CAPM analysis and you're like, well, I think Google is cheap. But then you open up your chart and it's falling and falling and falling. Cool. Wait till you find a double bottom, higher high, higher low, take the shot, drop a stop, and you're done. Yeah, that's right, King. Yeah. The producer yelled in my ear after that. He's like, "You got him, Wayne. You got him." Because it turned out I was set up to be on Fox Business so that they could tell the world that trading Forex was crazy and risky and foolish, kind of like meme stocks. Forex back then was like trading meme stocks. It was all just BS retail crap. Nobody knew what they were doing. It was all degenerate gambling. And I went in there and I sounded at least half reasonably intelligent. So yeah, that's right, King. That did happen. And so I thought I stayed stoic. and the producer cheered in my ear. "You got him, Wayne. You got him. Good job." But anywho, so I'm just trying to show you that I've had these opinions for a very, very, very long time. Maida says that was February of 2009. Stock market's coming down, and I'm telling the world, buy the dollar, buy the dollar, buy the dollar. Or at least there was the rationale behind it. Anyways. Oh, and, trade the trend. Cool. And that's what we're doing. Buying dollar and trading the trend. Yeah, I think I was about 14 or 15 there, Maida. My mom drove me. Actually, I had a limo. That's when you feel like a baller, right? The limousine pulls up in front of the TV station. This is for me. Sorry, I got an appointment. But why not? Anywho, yen. Yens are all down. Cool. What do you want to do? You want to buy it? And that's how I want to get you. All the yens are down. Cool. Right on. Does that mean I have to sell them? Well, you could. Okay. And I'm waiting for the next YCC. Do-do-do. So I'll leave it at that. I don't want to buy any of these yet, but I'm thinking about buying them. I guess one other thing. I guess we should do Bitcoin, gold, and oil. Okay. Yowza. Okay. Yowzer. So I had a frustrating morning. You know, when I think back to yesterday, I was waiting to buy in here. Let me make this a little thicker. I was kind of waiting to buy in here, and then it decided to make a lower low, so I walked away, and then well, you know what? I don't buy lower lows. So then it was way up here, and I'm like, I want to catch it down here, and I didn't see the setup in Asia. I looked at it, and it looked iffy at that moment. And I decided I'm gonna try to go to bed before 11:11 and wake up at 4:44. Okay, so I'm like, I don't want to hold and guess and bet, but I have my fundamental rationale. So anyway, so I was right here. And, well, a couple of things happened right at that second. And then it was here. And I couldn't buy it at resistance. Wait, is this quite right? No, I'm sorry. I got this. No, it was here. I'm sorry. My bad. This was Asia. Then it came back down. That's what happened. Came back down. And I was looking here, I was there, and then I blinked, and something happened right around then, and I got distracted, and then all of a sudden we were here, and I can't buy there because I wanted to buy here, but then and now what? Now I can't do it here. Well, so I guess the argument is, I'm trying, I override my greed with discipline. And yes, you could argue I could have just bought here and that would have been great, but it was playing off the resistance. Okay. What about the breach? Well, I'm doing my live stream. And then what about, just like, son of a bitch. But every day is a new day. Every trend has a pullback. And I suppose the argument is if I miss the setup that I want, what's 10 times worse is to take the trade you don't want and then lose. And then not just financially, but psychologically. So I can say, well, I can look again later today. I can look again tonight. I can look again tomorrow, and so on and so forth. And that it's sort of like painting the Golden Gate Bridge. If you're going to be like a day trader, it's like painting the Golden Gate Bridge. You start at one end, you work your way to the other. It takes you so long that you have to go right back to the beginning and start painting the Golden Gate Bridge again, because all the paint you started with all that time before is now worn out. So as soon as you're done painting the Golden Gate Bridge on the Marin side, you got to go back to the city side and you paint. And then you get to the Marin side, and then the city side is faded. So then you go and you just nonstop. And so you could chase this price, or you could just say, there's tomorrow, and then there's tomorrow, and then there's tomorrow, and then there's tomorrow, and then there's tomorrow. And then, and your job is to, and you've missed those. You just cannot have a living of chasing price up. Luis says, does gold go up or down during periods of high interest rates? The question is inflation levels. Okay. I'll tell you what goes up. Real assets. So you could have real estate. It could be physical gold. Okay. But some of that money has left the market and is not necessarily gold anymore. So historically, I would tend to say yes. Although I've never bought gold as an inflation hedge. Okay. That's that. I trade it like a currency. I look at this fundamentally. I look at yields. I look at various other things like you would a currency. And I don't see good rationale to own it. That's all. High carrying costs, no income, so on and so forth. Fundamentally, yes, it's near support, but I like uptrends, not sideways trends, especially sideways trends that might turn to downtrends, because I'm bullish on dollar, which in terms of dollar, an ounce of gold will be worth less because you need less dollars. So I don't know, but since we're going down story lane in Wayne's life, I think it was around this period here, I stood, I think it was Vegas? I think it was Vegas. Might have been New York City, might have been Vegas. But I'm at a trade show, a Traders Expo, I think it was. And I was hired by a broker to do a speech to get people into their booth. So I'm in the booth. They had a huge booth, like they had 10 booths, and they had this huge area. And so I was hired by the broker, do a speech, get people to come to our booth. Great. And I said, I want to do a speech on gold. And they're like, great. And I had a bullhorn. And I'm screaming in the bullhorn, buy gold. Right in here. Buy gold, Bubba, buy gold. I haven't been too excited about gold, generally speaking, just because very often I just get better, shorter term opportunities than gold. And that was great. And then it came back. And then, look, then it moved sideways for years. Then it popped. It's moved sideways for years. Could you argue, I guess, if you were going to be a gold trader, that somewhere in here is a buy and that we're going to go to 3,000? Make the call. Make the call. But if you said, what about, prolonged dollar strength? Well, then that would bring this down. So then you have to ask yourself, instead of asking about gold, ask about dollar. Because maybe you're better trading gold and euro or something, right? But, excuse me, gold and price of dollar. Why is dollar strong? Is it the interest rates going up? No, I don't believe so. I can show you that in years past, interest rates go up and the dollar falls. Oh, so what's different this time? Well, no Fed put and supply chain problems. So X minus M, the value of the dollar goes up. And if gold does nothing, this chart comes down because of net exports. That's it. If demand is the same. So now, Luis, if you're like, well, I think demand is going to increase for gold, well, then you should wait until the dollar strength disappears. So I would look at GDP and strip out GDP minus, right? Look at GDP and then analyze X minus M. So it's not an equal sign. I don't know what this is. And look at X minus M inside of GDP and wait for M to go up. And probably if inflation's coming down in terms, since X minus M is in dollars, X will come down based on a change in value of dollar. M will go up when China starts producing and shipping products. So is that Christmas? Near Christmas? Is that October? Or is that April? Well, you're going to have to do some fundamental analysis that will help you say, well, demand for gold might be going up, which pushes the value of this up. But if dollar's also going up, then this is moving sideways. So should you buy it? Well, if you think it's going to go sideways, you can buy it down here and just sit on a mediocre trade. But then your next analysis is, when does M go up? In particular, when is M higher? When is, I guess you do it this way, when is M greater than X? This is your question. Is that September, October, or is that April, May? And if you think, well, I think it's going to be a rough Christmas, then you don't buy gold. If you're like, yeah, I think there's going to be a big recovery and that China is going to stimulate its economy now that it's opening up, and it's going to like rain money on all the most important exporting factory businesses, then great, then make the play. But I need you to break it down and tell me. Okay. Okay. Oil, gold, and then we got to do biddy. Okay. And that's that. Lovely, tell your mom. Okay. Another leg or two down. I don't know if people are defending 20. Okay. But there, like I said, this downward move could plausibly be margin calls and stuff. So the more it falls, the more it's likely to fall. And then, because what's the psyche of the market? Buy it at 20 or wait and see about 20? And are there people sweating bullets? Are people bleeding? Are people on their hands and knees praying today? There are, by the way. I don't know if you know that, like when you watch these markets, there are people right now on their hands and knees praying for this to go up. And they will be liquidity events. They will get liquidated and they will leave the market, and that's a good thing. So if you're a hedge fund manager that's doing okay in this market, next year and the year after and the year after and the year after and year after will be fantastic, because we've flushed out all the bullshit traders with their stupid strategies and their dumb clients and their dumb money. Okay, trillions were, right, over $1 trillion were wiped out of the stock market yesterday. Good, because somebody else made that money, right? So the market cap came down, so it's not quite true. But anyways, the dumb money gets flushed out, and the kings survive. And the jesters are gone. And I hope that's you. Because I try to teach you how to survive first and foremost. It's okay to lose money, to have losing trades, but it's not okay to make mistakes. It's not okay to gamble. It's not okay to hope. It's not okay to leverage up. It's never okay to go big. Brent says we need dumb money to make money. Sort of. I know what you're saying down the road, but there's a reason capitalism has booms and busts, and the more that the government gets involved to prevent it, the more that they're making mistakes. But dumb money needs to get flushed. But remember, every bottom creates a new opportunity for a rally, and every top creates a new opportunity for a reset. And now, if you think about it this way, Bernd, the smartest of the smartest are able to take advantage of these cycles. Sometimes it's dumb luck. Sometimes it's precision strikes. Okay? I can't think of the guy's name. What's his face? I have Tepper in my brain, but it's not Tepper. Anyways, this one guy saw COVID coming. I can't think of his name. He's a hedge fund manager. Anyways, so what he did, he didn't want to dump his stock market portfolio because he thought maybe the Chinese flu, as Trump called it, was going to hit America. So instead, he bought a whole bunch of options. Sure enough, it hit, stashed, and he made a ton of money in the options trade. And then right at the bottom, he took all that money he made in options, threw it all back into the portfolio, and it rallied it back up probably, 150%. Precision. The right thing to do at the right time. Okay? And then others just held on, like Kathy Wood just held on. Oh, growth in a global recession. Right? So anyway, so she made a lot of money on the stay-at-home COVID play, but did she get out at the top? That might have been the difference, right? So yeah, she might have had stocks that were up 1,000%, but now they're not. So anyways, so I'm trying to teach you to be conservative and disciplined and risk averse. You can do whatever you want. It's your money. But I'm trying to give you good habits. Okay? And Seneca, as he was teaching Marcus Aurelius, he was trying to say it's your habits that are important. What it comes down to is what you do day in and day out. Your habits are what define you. So I'm trying to teach you good trading habits. We're all different. Different ages, different races, different religions, different sexes, different sexual preferences. It don't matter. It comes down to, as a currency trader, what your habits are, and your habits are going to define you. Maybe you're less risk averse than me. You'll probably make more money than me when times are good. And then when times are bad, you'll probably lose more money than me. So what's the difference? Value at risk. That's it. You're a higher beta. Sweet. It's all good. And if I teach you anything, if I'm a really good teacher, you could be a high beta trader, but then when things go bad, you cut fast and you go conservative fast. That's what I'm hoping for. So that's the difference between your sharp and your Sartino. Okay? This has vol. This has bad vol. Okay? That's the difference. So this is good and bad. Good, bad, vol. And this is just bad vol. So I'm trying to say, like, if you're really good, you make money on the way up, and as soon as it turns, you're out. And you're like, what bad vol? When the market goes against me, I'm out of the market. Nice. Then I say, job well done, coach. So, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. I'll see you again soon, eh? Eh? Cheers.